fast forward button on your financial goals.
Who doesn't?
Right. Well, today we're diving into a strategy that might just let you do that. It's called leverage. You've sent us some really interesting stuff on this, especially this article from a podcast called Margin World.
Yeah, that's a great place to start. And they use such clear language, which is really important with a topic like this.
Absolutely. So, for those new to the idea of financial leverage, can you break it down? What is it and why should we care?
So in the simplest terms, leverage is using borrowed money to potentially amplify your returns on an investment. Let's say you've got like $10,000 to invest. Without leverage, your potential profit is limited to how well that initial $10,000 performs.
Okay. Makes sense so far, but how does the leverage part come in?
So imagine you use that $10,000 to secure a loan. You're effectively doubling your investment capital to $20,000. Now you have twice the potential upside, all because of those borrowed funds.
So it's kind of like you're giving your money a superpower or something.
Yeah, something like that. Yeah. But, and this is really important, with great power comes great responsibility, right?
Yeah, there's always a catch, isn't there? It sounds almost too good to be true.
Well, and that's the thing about leverage. It's not inherently good or bad, but it can magnify both your gains and your losses. And what's really interesting is we actually encounter leverage in so many areas of our lives without even realizing it. Think about a mortgage. That's a classic example of leverage.
Oh, that's a good point. You're using borrowed money, often a huge amount, to buy a house that you probably couldn't afford otherwise. I remember Margin World talked about how common leverage is in real estate.
Oh, yeah, for sure.
And it helps people become homeowners who might not have been able to otherwise, which is a pretty big deal, especially if you're listening and, dreaming of owning a home.
Exactly. And it's not just for us regular folks either. Businesses use leverage all the time to, fuel their growth, taking out loans to expand their operations, to buy equipment, or to develop new products.
It's like leverage is a tool, but you need to know how to use it to build something amazing. Otherwise, things could get messy.
Yeah, that's a great way to put it. And, we'll get into those potential downsides a little bit later.
Yeah.
Because understanding those risks is just as important as recognizing the potential rewards.
Okay, so we've established that leverage can be a really powerful tool for, achieving our financial goals.
Sure.
But like with any powerful tool, it has its own risks, right?
Yeah, that's exactly right. And it's so important to understand those risks, before you even think about using leverage.
Absolutely. So let's get into the potential downsides. What are some of the things that we need to watch out for when we're thinking about leverage?
Well, I think the most important thing to remember is that debt, no matter how strategically you use it, still has to be repaid.
Right.
Even if your investment, doesn't perform the way you hoped, you're still responsible for those borrowed funds.
That's a good point.
And this is where understanding what the debt-to-equity ratio is becomes really, really important.
Right, because it's not just about how much money you could gain, but also how much you owe, right? And how those two things balance each other out.
Precisely. Think of it like building a tower, okay?
Okay.
Your equity, the money you've personally invested, is the base.
Okay.
Debt is like the blocks you add on top.
Uh-huh.
And the higher you build with that debt, the more impressive it might look.
Yeah.
But it also becomes inherently less stable.
Right.
Too much debt is like having a shaky base.
Yeah.
One wrong move and the whole thing could just collapse.
That's such a good analogy.
Huh, thanks.
So how much debt is too much debt? How do we know if our tower is about to fall over?
Well, that's where, you have to carefully analyze and assess the risk. There's no magic number when it comes to, the perfect debt-to-equity ratio. It really depends on your situation, your risk tolerance, the specific investment you're looking at, and the overall market conditions.
So it's really about finding that balance, right?
Yeah.
Maximizing your returns, but also, managing your risk.
Exactly. And another really crucial thing to think about is the impact of interest rates.
Oh, right, because when you borrow money, it's not free.
Exactly. Those interest payments, they're just a part of leverage, and they can really impact how profitable your investment's going to be.
Yeah, that makes sense. If the interest rate on your loan is higher than the return on your investment, then leverage could quickly become a losing situation, right?
Absolutely. And, to make things even more complicated, interest rates can change, especially with loans that have variable rates.
Oh, right.
That means that your monthly payment could suddenly increase, and that can put a real strain on your finances.
It's like you're walking a financial tightrope or something. You gotta maintain your balance while everything around you is moving.
Exactly.
Yeah.
And speaking of factors that can impact your leverage strategy, we can't forget about liquidity.
Right. How easy it is to turn your investment into cash.
Exactly. Liquid assets, like stocks, you can usually buy and sell those pretty easily.
Hmm.
But other assets, like real estate, those are considered more illiquid. It takes time to find a buyer and then, go through the whole process of selling.
Right. And that's not ideal if you need cash quickly.
No, it's not. And that's where leverage can actually magnify your losses.
How so?
So let's say the market takes a downturn, and now you need to sell those assets to cover those debts. You might have to sell at a loss just to meet those obligations, and that could wipe out any gains you were hoping for.
That's like a double-edged sword then. Leverage?
That's a great way to put it. It really magnifies everything, the good and the bad.
Hmm.
It's just so important to really grasp those risks before you jump in.
Absolutely. And to know how to mitigate those risks, which maybe that's something we can dig into a little bit further. Okay, so we've talked about the potential downsides of leverage.
Right.
But let's not forget about why we were interested in the first place, the potential rewards.
Yeah.
It's time to bring this all together with some real world examples.
For sure.
Margin World had a really good example about real estate.
Hmm?
Remember that $100,000 property we talked about? The one with the $20,000 down payment?
Yeah.
The example where you finance the rest through a mortgage. Classic leverage.
Exactly. Using leverage.
So they walk through what would happen if the property value increases to, let's say, $120,000.
Right.
Because of leverage, you'd essentially be making a 100% return on your initial $20,000,
100% return. Yeah.
which is incredible.
It's amazing.
But of course, no investment is guaranteed.
Right.
What if the market goes down? Let's say the property value drops to $80,000.
Yeah. That's when you would be what they call underwater,
Underwired.
which means you owe more on your mortgage than what the property's actually worth.
Oh, I see.
And that's the thing with leverage.
The double-edged sword.
Exactly.
It just magnifies everything.
It magnifies all of it, the ups, the downs.
And it's not just real estate, right?
No, not at all.
I mean, they talked about how hedge funds use leverage in the stock market,
Oh, yeah, for sure.
often with way higher stakes.
Way higher, yeah.
And they gave that really interesting example of long-term capital management, LTCM,
Oh, yeah, LTCM.
which was made up of all these brilliant minds
Some of the best minds in finance.
who were using massive amounts of leverage to try to get these huge returns.
Huge returns, and it worked for a while.
But then the market, shifted in a way they didn't expect.
Nobody saw it coming.
And those losses, because of the leverage, were just amplified.
Amplified to the point of collapse.
Yeah, it was a huge collapse.
It was. It was really something.
And it just shows that even the smartest people can get tripped up by leverage.
Yeah, leverage doesn't discriminate.
So it seems like the main takeaway here is leverage can be a powerful tool for building wealth,
It absolutely can.
but it takes careful planning and a strategic approach.
You can't just jump in blindly, that's for sure.
So any practical tips for using leverage safely and effectively?
Yeah, well, Margin World has some good advice.
Okay.
They recommended starting with conservative leverage.
Okay, so don't borrow the maximum amount right away.
Exactly, because you don't want to be caught off guard if things go south.
So basically, don't put all your eggs in one basket.
Exactly. And diversifying your investments, that's key too, across different asset classes.
That makes sense. Spread the risk a bit.
Exactly. And they also emphasized constantly monitoring your debt-to-equity ratio.
Okay, so keeping a close eye on that balance is important.
It's crucial, yeah.
It sounds like leverage is a bit like fire.
Oh, like that.
In the right hands, it can be a really powerful tool,
Yeah, for growth and warmth, just like fire.
But if you're not careful, it can quickly rage out of control.
100%. Great analogy.
So as we wrap up here, any final thoughts for our listeners?
Yeah, as you continue to learn about finance and you're thinking about your own financial goals and whether leverage has a place in those goals,
Right.
just remember to ask yourself, how can I use this powerful tool responsibly and safely?
That's a great question for all of us to consider.
It is.
And on that note, keep those minds engaged and happy investing, everyone.